So we're starting a brand new unit talking about loans and credit. And in this first section, we're talking about just the basics, just starting to understand some of the terminology, starting to understand some of the simpler ways that credit kind of works. And the way we're going to talk about credit, we can talk about credit in three different ways. The first way we can classify types of credit is by looking at the way we repay that debt, right? So when we're talking about credit, of course, the big thing is we're talking about some kind of a debt. And if we talk about by payment, then we have installment loans, and we have what we call a revolving line of credit, or just revolving credit, revolving line of credit. And installment loans have a fixed balance, and you're just trying to pay down that balance, right? There's some kind of maybe a specific purchase. You can think of student loans would be an example of an installment loan, a car loan, right? So we have some kind of regular payments to pay off interest and principal. So as I said, one of the examples of this would be like a car loan or like your student loan, right? Where you have a balance, right? Maybe I take out a $10,000, $20,000 loan for a car. Well, I have to pay off that $20,000 and I'm going to do that over a period of time. Revolving credit, you have some kind of a limit. This is what we call an open line of credit. And with that open line of credit, you can use it for whatever you want as long as the total of all your purchases stays under a limit. Right? So you have a credit limit as well. Payments might vary each month depending on how much you spend, right? Depending on how much of that line of credit that you use. So the perfect example, really the easiest example I can come up with is just your standard issue credit card, right? You have some kind of a credit limit. You can max out that credit card. You shouldn't, but you can. And your payment each month is going to depend on how much of that credit line that you use. So that's if we were talking about credit by the way we can pay off our debts, that is the way we would do it. The other way we can talk about credit is talk about what we call our assets. And assets are just, let's say, property of value that we own. So we have secured debt and we have unsecured debt. And secured means exactly what you might be thinking of. It's protected. What's it protected by? It's protected by something called collateral. So secured debt is tied to a specific asset, and we call that specific asset, that thing, collateral. And that collateral is repossessed if the debt is not repaid. So again, a car loan would be an example of a secured loan. Your mortgage, which is a home loan, would also be a secured debt, right? If I don't pay off my car, the bank comes and they take my car away. If I don't pay my house, I lose my house. So it's a secured debt. Unsecured debt is not tied to collateral, which means usually instead there's some kind of fees or other penalty for not repaying your debt or the loan. So examples of this, again, would be like your student loan, would be like your credit card. Right? With a student loan, right, if I fail to pay my student loan, they can't come and take my diploma away. But they can make my life pretty miserable if I don't pay my debt. And that's something we're going to talk about when we talk about student loans in greater detail later on in the year. And then the other thing we can talk about is to talk about the interest rates and the way that interest rates are assessed on different types of credit. And the first way we can come up with an interest rate is just a fixed interest rate. And then, of course, if it's not fixed, then it varies. So we would call it a variable interest rate. And it's exactly what it sounds like. A fixed rate is going to remain the same throughout the loan term. So again, like a car loan or like a student loan, right? When I took out a loan on my car, the interest rate they gave me is the interest rate that I paid for the entire term of the loan. Variable interest, as the name suggests, may change. They do have to tell you when it's changing during the loan period, so during the term of the loan. And that's based on some index rate, based on what we call a prime rate, or what we call an index rate. Mortgages can be variable rate interest, can have variable rate interest, mortgage. Credit card interest rates can also change. Um, and with credit cards especially, they have to tell you well in advance if that rate is going to change. Well, when we look at, let me zoom out here, when we look at these three things, when we look at these three classifications, we can actually lump different types of loans into each category, right? I actually already did, right? The car loan is an installment loan. It's a secured loan and it pays fixed interest. And we can do that with a whole bunch of different types of loans, right? So again, a car loan, we're going to take one from each category. It's an installment loan. It is a secured loan because if I don't pay it, I get my car taken away. And it has fixed rate interest. You can do this with any type of loan. You can put it in each of the three categories. One type of installment loan that is fairly simple, and it's a good way to start understanding how repayment works on a very basic level, is with a finance charge or just a simple repayment plan. This is something that's a little harder to find nowadays. It was a big thing when layaway was super, super popular, and layaway still does exist. It is still popular, but a lot of times now with layaway, stores will do this almost like a line of credit or like a typical, um, almost like a credit card type of thing. Less so this now, but it is something you still might find, and it's a good way to start understanding just the way things like this work. So here's my situation, right? I have some kind of a big ticket item, and with repayment plans, this is where you would see it the most often. So maybe I have a new set of kitchen appliances, and they cost $2,240 to purchase. This sounds important, so I'm going to highlight it. The store requires a 15% down payment, and that remainder plus a 7% finance charge is paid back over 2 years in monthly installments. And I want to know what my monthly payment's going to be. So, well, this finance charge is just to say, well, if you're going to try to pay this off over time instead of paying it in one shot, to make sure that we can trust you and to make sure that you do it, we're going to assess you a fee because it's going to be a lot more work for us to make sure that we're actually getting our payments and to hunt you down if you're not. So that's why the 7% finance charge kind of comes into play. That can be an interest rate, a percentage, or it can be a flat rate. In this case, it's a percentage. There's no formula to this type of problem. It's all done in pieces. And it's all done with thought process. So I have a $2,240 set of kitchen appliances, and the store requires a 15% down payment. So it would probably help us to figure out what 15% of 2,240 is. And I have $336 written down. So that's how much that I'm going to put down up front. Tell them, yeah, I'm going to pay this off. I promise you I'm going to pay this off. And to prove that, I'm going to give you some money. Well, the next thing in our problem says the remainder plus a 7% finance charge is paid back over 2 years. So how much is repaid? Let's figure that out. Well, it's the remainder, so it's whatever's left after paying the down payment, and it's a 7% finance charge, and that finance charge is applied to the remainder. So it's 1904 times 0.07. So that'd be 133.28. And we can add those together, right? And I get 20, 37, 28. So this, pick a different color here, this is what I'm actually paying back. So we'll call this the total to be paid. Well, we're taking that total and we're splitting it up over 24 months, over 2 years, in monthly installments. And that's where I got the 24 from, right? 2 years in monthly installments, and that is 24 months, so 24 payments. So I'm going to take that 20, 37, 28, I'm going to divide it by 24 to get my monthly payment, which is 84.89 a month. Right, so it's all about the thought process here. There's no formula, there's no magic way to do it. You just got to kind of think through it. Right? If you organize your work like this and you take it in pieces and really talk through the problem, you're going to find that this comes a lot more quickly and starts to make a lot more sense than if you try to just kind of panic and attack it all at once. Take it in small pieces, mark up the problem, and you'll find it much more helpful. So math aside again for a second, one last bit that I want to talk about is just how we apply for credit. Well, credit is all based on trust and honesty. Right? A bank or any other lender is not going to approve you for a loan or approve you for credit if they don't trust you to be able to pay it back. And this is actually a pretty common thing that happens. People get denied for loans, they get denied for credit cards because they look at the bank or the lender looks at their application and says, there's no way you're going to be able to pay this back like you say you're gonna. So lenders need to be confident that your debt will be repaid. And as I just said, you tend to complete some kind of a credit application. Which basically is your defense for, are you able to actually get this loan? And broadly speaking, there are 3 big parts here. The first thing is your assets. There's that word again. Right? This is anything that you own and everything you own. So they're going to look at if you own a house, if you own multiple houses, if you own a car or multiple cars, anything else of value that you own. Are you renting? Are you buying? What are you doing? Especially if they're looking at things like mortgages and car loans, how have you been able to pay that back? Things like that. The next thing is earning power. And earning power is your ability to earn money now and in the future. To earn money now and in the future. Okay, so if I'm applying for a loan and I have no income, they're going to be really skeptical of my ability to repay the loan. Versus if I've been established for a while, I've got a stable salary, I clearly have a stable salary based on my application, they're going to be a lot more willing to give me my loan, but also give me a better interest rate because they can trust me, or it looks like they can trust me based on some of the numbers that I'm showing. Obviously, unexpected things happen, right? You lose jobs, you get pay raises, pay cuts. This, of course, is a rough guide, and we'll talk about some of those consequences later on in the chapter. The last broad thing, and it's really something that we're going to spend a lot of time talking about in the next section because it's really important and it's really, it can be complicated, and that's your credit rating or your credit score. This is essentially your credit report card, and I'm not going to go into too much detail in it now because we're going to talk about it in the next section. But we talk about how well you've met your past financial obligations, right? How have you kept up with previous loans? No different than a relationship with any other person for any other thing, right? If I'm an employer and I'm looking at other employees and say, well, how is he in past jobs? How did he do in similar positions? Would I be able to trust him to handle this position based on his past? And that's what this credit rating is saying is, can I believe that you handle your debt well? Do I trust you to handle this debt well based on how you've upheld other debts in the past? So these 3 things are really going to be kind of our guiding force for this unit, and kind of looking at how these 3 things impact your credit score and your ability to take out loans.